Hello, I'm David Frazier, the President and Chief Market Strategist of Frazier and Mayer Research, LLC, the providers of Investors Monitor and InvestorsMonitor.com. And this is our daily financial market show, which we're referring to as our Market Insights show. And we're recording today's show at around 5:45 p.m. Eastern Time on Thursday, August 27th. So, as those of you that have watched our shows in the past are well aware, what we strive to do on these shows is to tell investors, traders, and stock market speculators, financial market participants in general, regardless of whether they're individuals or investment advisors or even small hedge fund managers, actually, because we offer our research services to all of those persons. What we strive to do is to tell you everything that you need to know, but nothing more regarding factors and developments that are likely to affect the value of your financial market portfolios. So, today, stocks here in the United States rebounded fairly sharply for the second day in a row. Let's get some specifics for you, even though you probably already know. For example, the Dow Jones Industrial Average closed up 369 points today as compared to yesterday's close. And the S&P 500 index closed up approximately 47 points today. That's 2.43% versus yesterday's close for the S&P 500, and the Dow was up 2.3% versus yesterday's close. And not surprising, for the most part, with a few exceptions, but for the most part, I heard on the approximately 15 minutes that I tuned into the major broadcast financial shows again today, that most of the folks on those shows were saying, okay, see, this is what we were telling you. Everything's fine. The stock market's not going to fall apart. The impact from China on the U.S. is going to be minimal, and the U.S. economy is still strong and growing. Well, as I've tell our listeners and viewers on a regular basis, you can listen to that nonsense if you choose to do so, but only at your own peril. And what I mean by that is, look, there are some smart and knowledgeable people that go on those shows from time to time. But it's actually pretty rare, and I guess I don't really know that, whether or not, for all I know, all of the people that go on their shows are smart and knowledgeable. But it's either they're not knowledgeable, they're not experienced enough to look at the correct indicators regarding indications of where stocks, bonds, precious metals, gold, real estate, whatever it is, whatever asset class it is, they either look at the wrong indicators, they're not experienced in the right areas, or they're purposely misleading investors, traders, speculators, and their clients. And I'll leave it at that. I don't know which one it is. Doesn't really matter to me. All that matters to me is that I and we at Frazier Mayer Research and InvestorsMonitor.com help you, our viewers and listeners, to avoid the major downturns in the financial markets and to participate and profit from the big upturns. And we've been very good at that over the past almost 16 years. I won't get into the details here, as I've mentioned some of our calls in the past, but you can go to our internet website, InvestorsMonitor.com, and click on under the, if you put your mouse over About Us, you'll see a drop-down menu will come up, and it'll be a link for our historical forecasts. And you can just look at a chart of those historical comments and predictions and pieces of advice that we gave to investors over the past approximately 16 years, and you'll see that we've been very good at getting people in and out of the stock market at very opportune times. And by the way, all of the buy and sell notes that you see on the chart on that page, we have documentation to support all of that. So we stand behind whatever we claim. Whatever we claim is true, and we have thorough documentation to support it. So, does that mean we're smarter than the next guy? Yeah, I don't think so. But it might mean that we do at least probably each of the following, at least one of the following. We probably do a lot more research than a lot of other folks, whoever they are. And one thing that I know we do, I won't say whether or not our competitors do it, but we look out for the interest of our clients and our visitors to our website, our listeners, our viewers. We really do. We look out for the interest of our clients and other folks instead of just doing what's best for us financially. So having said all that, let's get right into this. We already had 2 long TV shows during each of the past 2 days. So today's show is going to be a little shorter. And the reason being, as I said yesterday, is, and as I alluded to a few minutes ago, is we strive to tell you everything that you need to know, but nothing more regarding factors and developments that are likely to impact the value of your investment and financial market portfolios. So, if there's not a whole lot to say, we're not just going to take up your time and our time and tell you some interesting story. We're just going to focus on the facts, and it might take 5 minutes, it might take 20 minutes. And today's TV shows, I think, will be done in about 5 more minutes from now is all. So let's get right into it. So, yes, U.S. stocks rebounded pretty sharply during each of the past 2 days. And but the important point is, where are they headed from here? Well, we don't know. We don't have a crystal ball. But I can tell you what our indicators are telling us, and we look at more than 100 economic indicators and other financial market indicators from around the globe on a monthly basis, on a very regular basis, really. We look at several during any given day. And these indicators are continuing to tell us very clearly that the U.S. economy, economic growth in the U.S., that is likely to slow over the next few months. Economic conditions are likely to worsen a bit. And next, that corporate revenues and operating results are probably going to be weaker during the next quarter than what they were during the quarter ending in June. And by the way, our initial analysis indicates that the quarter ending in June, that's the 3rd quarter in a row that, is it the 3rd? 2nd quarter in a row, I think, that earnings at the growth, the increase, the pace of increase in corporate earnings slowed. So we already have 2 quarters in a row. And our early research indicates that we're going to have the pace of increase in corporate earnings, on average, for publicly traded companies, slow further or during the quarter ending in September. And that a larger number of publicly traded companies will see their revenues and earnings decline during the quarter ending in September versus the quarter that just ended in June. So, we just go with what, we do what the Fed often says, even though I think we do a better job at it based on our track record and the Fed's track record, and that is we go by what the data tells us. And so the data is clearly telling us that this is not the time to be in stocks. Are we sure we're going to get this right? Of course we're not. Stocks might head higher, but it doesn't matter. And the reason it doesn't matter is we got our clients and investors that listen to us out of stocks on May 6th of this year. That was only 2.5 weeks before the S&P 500 index and the Dow Jones Industrials peaked. Only 2.5 weeks before the major stock market indices in the United States peaked. And since then, stock prices in general, as measured by the major indices, have trended lower, falling sharply, as you know, over the past approximately week, over the past, about a week, over the past week. So our clients and people who listen to us, they don't need to be concerned about where stocks are headed over the next few days. They're sitting in cash and it's in money market securities. They're out of the stocks. They're sleeping comfortably. They're not worrying about any of this. They don't need to worry. And I'm very, very confident that we'll get our clients and investors who listen to us, as well as shorter-term traders and speculators, I'm confident that we'll get them back in stocks at very appropriate times. At the absolute bottom in the indices, probably not. But if we perform like the way we have in the past, we're probably going to get them in near the bottom. And I'm not sure even that matters. What matters is that you protect the value of your portfolios. That's the most important thing. Protect what you already worked hard for and saved and invested. Protect the value of those portfolios, because there will be plenty of opportunities to make gains. Now, having said that, let me look at a quick notes here. Well, so the major stock market indices for the United States rallied back considerably over the past couple of days. And as I told you in yesterday's video, and via a chart of our overbought, oversold indicator in our lead article that we wrote for the homepage of our internet website on Wednesday, Wednesday, August 26th. That is yesterday. If you read that entire article that's displayed on the homepage, you go to the bottom and click Read More. It'll take you to a page where you'll see a chart of our overbought, oversold indicator, which I discussed in yesterday's video. Stocks being oversold, substantially oversold. That is, most people that were thinking about selling had already done so, and only people that were interested in coming in and buying were getting aggressive in the market. So, of course, we saw a rebound in stocks over the past couple of days. But guess what? Now, all of the major U.S. stock market indices, as of today's close, have now risen back to pretty significant price resistance levels. And this is important. Now, you might have already noticed, unlike many people that claim to be experts, we don't call ourselves fundamental analysts. We don't call ourselves technical analysts. We don't call ourselves bottom-up analysts. We don't call ourselves top-down analysts. Why? Because we approach the markets in all of those ways, meaning we look at everything that we can to give us information on where the markets are likely headed. And historically speaking, when you have a big drops in stocks and they fall to major price support levels, and price momentum indicators show that they're oversold on a short-term basis, you usually get a pop. And then historically, when you get after that rebound, take stocks back to major price resistance levels, you usually see stocks not moving any higher from there, especially during environments where economic indicators are telling us that we're going to see a slowdown in the pace of economic growth. Quite the opposite. When they rally back to those price resistance levels, then they tend to turn lower again. So my guess is on Friday of this week that stock prices in general here in the U.S. will turn back lower again. And I don't really care whether we get any particular day right. That's not our objective. Our objective is to help our clients and investors manage the risk, to limit their losses, to avoid the big downturns and to profit from the major upturns. So let's see. Let me look at a couple of notes here that I made. There's one other thing. I'll find it very interesting. Let's put it like that. So, the vast number, not everyone, but the vast number of so-called financial market experts and portfolio managers that were on the major broadcast financial TV shows over the past few days were telling everyone, those shows' audiences that don't worry, stocks will they'll come back. There's no need to get out. Everything's going to be fine. Well, let's see if you find this as interesting as I do. That's interesting that that's what they're telling their clients and other investors. But then we should be taking a look at, well, what have they been doing with their money? And here's what they've been doing with their money. Institutional investors, in the aggregate, reduced their holdings in stocks and added to their holdings in money market securities, that is, in cash-like investments, during each of the past 3 months. And during each of those 3 months, they accelerated their purchases of money market securities. That is, they added more money than they did during each of the prior months. So they're telling their clients and investors in general not to worry, to continue to hold on to their positions, But boy, they've been reducing their positions in stocks and adding to money market securities. You got to love that, don't you? Doesn't surprise me. It's very, very typical. Now, there's one other thing I want to note, and then I'm going to wrap up today's show. Please don't think that we're one of these perennial bears that happens to come along and get our forecast correct every 5 to 10 years. Now, I'm referring to people such as Harry Dent. You can do your own homework on him, and I strongly encourage you not just to read his very emotional and what appear to be very insightful articles and books and comments on the financial markets, but to go back over time and to look what he said over the past 10 to 15 years. I think he maybe got one market downturn correct, but other than that, he's been pretty much wrong about the directions of stocks, except during very short periods for at least 10 years now. Same is the case for Peter Schiff. You've probably heard the name. Go ahead, look at his track record. Go back and listen to what he said in the past. Same is true for Robert Proctor. Now, my partner doesn't like me identifying these other folks and saying bad things about them. You know, actually, I haven't said anything bad about them. I'm not going to say anything bad about them. I'm just telling you, you might want to take a look at what they've said over the past 10 years and decide whether or not you should listen to them. I think you'll find out if you do some homework that they tend to be perennial bears. They're always bearish on the markets, or almost always. Let's see. So I think that's it for today. I thank you for listening, and I invite you to tune in again tomorrow on Friday. Thank you.